The following section will explain how to complete the cash flow from investing activities and the cash flow from financing activities. Now that we've determined our cash flow from operating activities, we need to move on to the next component of our statement of cash flows. The cash flows derived from investing activities are those cash activities which resulted in a recognized asset in the balance sheet. Remember, the cash flow from investing activities is the same whether we are talking about the indirect or the direct method. Under either of these methods, we first must determine if there were any cash receipts based on assets we might have sold. This would have increased our cash or created a positive cash flow, so we would want to add that to our equation. Conversely, if we bought or acquired assets by paying cash, this would have reduced our cash, so we want to deduct that amount from our equation. So where do we get this information from? The specific information that we are talking about must be gathered by researching the major business events which impacted cash. The cash-related business events comes from examining and analyzing your general ledger or any means of determining cash movement, even if it's simply pulling information from a properly reconciled check register. Understanding your business and the key business events is critical to efficiently documenting those items which impact cash. We'll use our balance sheet, as we demonstrated previously, to confirm that these items reflect cash receipts or payments and not accruals, receivables, or payables. For purposes of this demonstration, the list of significant business activities should be considered in preparing the section of the cash flow statement. The first thing we want to look for is any cash receipts resulting from the sale of plant assets. The item immediately preceding the last item states, received cash from selling equipment, $26,000 book value. We see that the actual cash received was $32,500. Since we are focused on those items impacting cash, we will use the $32,500 and add it to our cash flow from investing activities. Next, we want to see if we purchased anything which ultimately became an asset. In this example, the very first item indicates we purchased new equipment in the amount of $208,000. Since our purchase reflects a cash payment, we will deduct $208,000 from our cash flow. If we add these activities up, we derive a net reduction in cash flow from investing activities in the amount of $175,500. The final category in our statement of cash flows is the cash flow from financing activities. Cash flow from financing activities refers to those activities related to obtaining funds from outside sources. Just like the cash flow from investing activities, the process is the same for both the indirect method and the direct method. When we think of cash in or out of our company in terms of financing activities, we must look at any funding or cash received from our issuance of common stock, cash received from issuance of notes payable or bank loans. Of course, any repayments on outstanding notes payable or bank loans would be subtracted from our cash flow, and if we were to buy back or purchase treasury stock, this too would be deducted from our cash flow. And of course, any dividends we have actually paid to our shareholders during this period. To obtain this level of detail regarding cash movement, we must refer back to our cash-related business events which occurred during this period. Looking at this information, we note that we did receive $75,400 in cash from issuing common stock, so we add that to our cash flow from financing activities. We should also note that we took out a $57,000 bank loan or notes payable to receive cash for an equipment purchase. This will get added back to our equation. We further note that a $5,000 payment was made to pay back a portion of notes payable. Since money is being expended, it will come out of cash and therefore must be reflected as a negative to this cash flow. In this example, we also show a purchase of treasury stock, which will reduce our cash flow by $13,000. And finally, we paid out cash dividends to our shareholders in the amount of $6,500, further reducing our cash. In review, To determine our cash flow from financing activities, we refer to the cash-related business events. Keep in mind, this isn't a formal financial statement, but rather is derived from knowing your business and the transactions that have had an impact on cash. Based on that knowledge, we use the list of business activities and transactions which occurred during that period to determine cash received from issuance of common stock, cash received from issuance of notes payable, cash paid on notes payable, cash paid for the purchase of treasury stock, and cash paid for dividends. This gives us a total net cash provided by financing activities of $107,900. The only other two remaining items on our list are the purchase of new equipment and the cash flow from investing activities. You may recall that these two activities were accounted for under the cash flow from investing activities section, as they represented investments made by the company to create an asset. Further note that the information provided under the cash flow from financing activities heading is treated the same for both the indirect method and the direct method. So now we know the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. The sum of these three activities reflect a net decrease in cash of $13,000. Keeping in mind our figures for each of these categories, let's see how a real statement of cash flow looks using the indirect method. As you can see, the computations we use to derive the cash flow from operating activities, amounting to a positive $54,600, are clearly listed out in our preparation. The same applies for our cash flow from investing activities and our cash flow from financing activities, determining our net decrease in cash of $13,000. Much like our bank statement, if we were to deduct this net decrease in cash from our beginning balance, in this case we are stating that our beginning balance was $27,300, our ending cash balance would be $14,300. As previously stated, the only difference when preparing a statement of cash flows between the indirect and direct method lies in the cash flow from operating activities. The remaining cash flow from investing activities and cash flow from financing activities are treated the same under either method. If we look at the actual statement of cash flows prepared using the direct method, you'll note that although we prepared our cash flow from operating activities quite differently, we still come up with the same $54,600 figure, and ultimately the same result in our cash flow change. Whether we prepare our statement of cash flows using the less popular direct method or the more commonly used indirect method, we note our end results are the same for cash flow provided by operating activities, investing activities, and financing activities. Before moving on to our last topic on statement of cash flows, let's complete another quick knowledge check based on what you've learned so far.